Now, if you have an impairment of the investment value itself, then the investment needs to be written down to market value. And this becomes the new value for the equity method. And you cannot recover that write down. And this little example, I'm not going to go through this whole example, but this was an example that was here in the PowerPoint slides that'll help you see. These are some of these write-ups and write-downs and differential items. There's an inventory it looks like inventory was undervalued. Inventory was overvalued. That's why some parentheses for $6,500. Land was undervalued by $39,000. Equipment undervalued by $85,000. There was a covenant not to compete as part of the acquisition of $52,000, and that's amortized over 4 years. And there's also goodwill of $26,000. So how would these be affected when you've got this additional amortization? And this relates to, again, previously we did a 40% example. This is a 100% example, which is similar to what we're going to be doing in full scale in a couple of minutes. So what happened is that if you wrote down the cost of goods sold, later on, that's going to increase income. So that will be a subtraction here showing that it would increase the income from the sub, because the sub would be recording too much cost of goods sold. You actually wrote down some of those cost of goods sold, and therefore it's going to increase income. With depreciation, there's going to be additional depreciation, and there's going to be additional amortization of this not to compete contract of $13,000. That's $52,000 divided by 4. Now, if you're trying to see a rhyme or reason or figure out why some are being subtracted and some are being added, there's a simple rule that I think really helps. And that's, I call it what goes up must come down, or what comes down, what goes up. I used to use the thing from Karate Kid, wax on, wax off. You can think of it that way too. But, I don't know, what goes up must go down, what goes down must comes up sounds a little more, I don't know, it sounds a little more elegant. Anyway, because we wrote down the cost of goods sold, now it's going to write up income. Because we wrote up the equipment, now it's going to reduce income, i.e. additional depreciation expense. And because we recorded this covenant not to compete, that created an asset, so assets went up. Now income is going to go down by that amount. So what goes up must come down. What goes down, like inventory, must come up. And that's a good thing just to tell yourself as you're doing these problems. This is where a lot of people mess up, adding or subtracting, and which direction these things are supposed to go in. It can be very confusing. And yeah, you can plug numbers in to connect to get the right answer, so it turns green using check my work. But in the real world, you got to really think about these things and understand them.